Well, share markets around the world have gone into steep decline amid fears of a new global economic crisis. Australian shares lost well over $20 billion in value as the markets closed at its lowest level for about 12 months. The turmoil started after the United States reached a last-minute agreement to raise its international borrowing limit. European and Asian markets also had big falls, and the US has come under some sharp criticism over its debt levels. Hamish Fitzsimmons reports.
President Obama signed the legislation to raise the borrowing limit just hours before the nation would have defaulted on its debts.
It shouldn't take the risk of default, the risk of economic catastrophe, to get folks in this town to work together and do their jobs.
The deal might have averted an immediate disaster, but the political drama also put the problems of the US economy sharply back into focus.
Our economy didn't need Washington to come along with a manufactured crisis to make things worse. That was in our hands.
And the global reaction's been swift. European and Asian markets took a beating over fears of a new US recession, and some are predicting a very bumpy ride.
As problems continue to bubble to the surface, with Spain and Italy being in difficulty in this area of debt as well, with problems in Portugal and Ireland and Greece, as well as the US, we're likely to see ongoing issues that lead to market volatility.
The dollar dropped sharply and the ASX 200 hit a 12-month low, losing more than $20 billion by the close of trading.
Investors are basically fearful that even though the debt ceiling problems have been resolved, the US economy is actually quite a lot weaker than might have been hoped, and some are starting to worry that the US economy is on its way back into recession.
It shows that all the consternation we had last week about the budget ceiling and the debt ceiling in the US was really a side issue. The main game in financial markets now is the dangerous signs of growth slowing, both in Australia and globally, and investors are now starting to worry about a second recession in 2012.
The sharp falls have prompted some commentators to observe the Australian economy is not as strong as it may seem.
The weakness in retail sales, building approvals, private sector credit, all of those things are certainly a worry and suggest the Australian economy is much weaker than might have been expected a few months ago. Certainly, I think, quite a bit weaker than the Reserve Bank is allowing for.
But the government says Australia's outlook remains positive compared to the US and Europe, where Italy is now at the top of the economic sick list.
Our public debt is low and our budget is in good nick compared to those other countries.
Some analysts fear the US debt deal has only temporarily masked America's woes.
Their fiscal settings at the moment aren't credible. They aren't in the long run going to lead to a debt to GDP ratio, the simple sort of income to debt ratio that is sustainable.
And China says the deal failed to defuse what it calls the US debt bomb and plans to cut its investments in the greenback. Russia is also unimpressed.
They are living beyond their means and shifting a part of the weight of their problems to the world economy. To some extent, they are living like parasites off the global economy and their monopoly of the dollar.
Some analysts are more sanguine.
I think the United States looks rather foolish right now, but I don't think we will have lost our standing in the world per se.
More volatility may not be far away. Hamish Fitzsimmons, Lateline.